So, hi everyone. Now we'll be looking at chapter 8, which is about books of prime entry, but specifically we'll be looking at purchase journal and sales journal. Okay, so if you look at the first page of chapter 8, you will find that we have 7 books of prime entry. Okay, so we classify them as specific journals. So, if you know, there is another term where we call it journal. Okay, so in journal what we do is we debit and credit everything. Okay, and we disregard the concept of in which category it will be falling. Okay, but we do have journal here, which is not similar to this one because this is the main category and these are the subcategories. Okay, so under this category we have no further category. Okay, that's minus over there. Okay, there is no further category in here, but in specific journal we classify each entry into a specific account. So what it does is basically, okay, give me a second. So basically what purchase journal does is it records the transactions which are on credit. So the term credit is very important. So anything you buy on credit will go in purchase journal, and anything you buy on credit, anything you sell on credit will go in sales journal. Okay, but if it's related to cash, then of course it will go in cash book. So if you're buying or selling on cash, then it goes in cash book. Okay, so these two journals are specifically we'll be looking at today, and these focus on credit terms. So these are few of the examples, hypothetical examples. So if you buy the goods on credit, it will go in purchase journal. So basically what we are looking here is the concept of trade payables. So you are supposed to pay to trade payables. So all the trade payables we have in purchase journal. So purchase journal has all the trade payables. Okay, and similarly sales journal has trade receivables. Okay, so the concept is same, it's just that this one is trade payable and this one is trade receivable. Okay, so if you buy goods on cash, so see the term here is cash, only the difference in this statement is this one is on credit and this one is on cash. So if it's on credit it goes in purchase journal, and if it's on cash it goes in cash book. And if you buy assets on credit it goes in journal. This one, journal. Why is that? Because it is not trade payable, it's other payable. So the difference between trade payable is you buy the inventory from them, so you are only buying inventory from them. So inventory are the goods basically, you can say goods that you will be reselling. So non-current assets, what is the definition of non-current asset? The definition of non-current assets are the item you use for more than a year, right? So the item you use for more than a year, for example the furniture or the machinery, you do not sell them usually unless you have few circumstances where it's spoiled or you want to upgrade it. Okay, so if you plan to sell it, it is not classified as inventory and we classify it in other payable, so it goes in journal. Okay, not in trade payable. Trade payable is only for inventory. Okay, maybe I can make it red because it's the emphasis is on inventory here. And the first one is on credit, it must be on credit, and the second one it must be inventory. So the criteria is it must be on credit and it must be inventory. If it's on cash it goes in cash book. So it does not matter if you buy goods, if these goods are for resale or if it's a non-current asset. If it's on cash it goes in cash book. Okay, but if we buy non-current asset on credit then it goes in journal. Okay, and if we buy asset on cash, again it goes in cash book, because as I said, if it's cash, if you see the word cash directly you should know that it's cash book. If you sell on credit, so if you are selling something you bought earlier, now it should go in sales journal. Okay, because it is a trade receivable, you will be receiving the money. And then if you sell on cash, so emphasis on cash again, it will go in cash book. Okay, I have written CB here, cash book. Sell assets or dispose assets, again go in journal because these are assets. I said earlier, anything that does not fall into this one, or this one, okay, this one, purchase journal, sale journal, or cash book, it goes in journal. Okay, all other entries goes in journal. So the criteria for this one, I said, is credit. It must be on credit, and it must be inventory. You must be buying inventory. If you're selling inventory, it goes in sales journal. Okay, so customer return the goods. So now if the customer plan to return the goods to you and he bought it on credit, then it will go in sales return journal. Okay, if he return the goods on credit, okay, there is no cash return. Okay, there is no cash return. So this one we have goods returned to you also goes in sales return journal, because this is just the same thing in phrase differently. Okay, so you return the goods. If you plan to return the goods, it goes in purchase journal because you will be returning to the supplier. Okay, so it goes into this one. And if you pay rent $100, it goes in cash book because it is assumed you are paying via check. Okay, maybe I can write here a check. Okay, and then if you receive the discount, it goes in journal, and cash book. Commission received also go in journal. Okay, so now today's focus is this one and this one specifically, but before we go, if you look on the page 864, there is the definition of source document, which states written documents that provide information from which accounting records can be prepared. They prepare evidence that particular transaction took place. So basically, source documents are documents like invoice. So when you buy goods, you receive purchase invoice, and if you sell goods, you issue an invoice. So the couple of example of source document are these. Okay, so we have invoice here, we have receipts, we have checks and stubs and deposit slips, we have payment vouchers, debit, credit note, bank statement, this one, and all these things. But basically we'll be looking specifically at this one. Okay, what did that happen? Zoom to maximum. Okay, specifically we'll be looking at this one, and receipts we'll be looking later on. Payment vouchers we'll be looking at, debit note we'll be looking at, and credit note. Okay, and I'll be explaining as we go on through the journey what is what. So basically invoice, I believe you know. So if you are buying something, and let's say you buy something from Speedmart, they will issue you the receipt. That receipt can be called as invoice, although there is a slight difference in what is receipt and what is invoice. And then similarly, if you are selling something, you will be issuing the invoice to the customer. Okay, so both are invoice. One is purchase invoice and one is called sales invoice. It's just a matter of classification. And then we have the transaction are usually given like this. So if you buy the goods from ABC, okay, then you have to post it into purchase journal. So basically the format looks like this. So purchase journal you can write in the middle maybe, okay, and then you can have the format like this. So the first column is date, second one is detail, then we have invoice, and then we have amount. Okay, so if you have this statement, you buy the goods from ABC on 12 January 2003, $420, and the invoice number is P1203, then you should be recording the date 12 January 2003. The supplier, this is the supplier, so ABC Limited. This is the invoice number, and this is how much you bought it for. And you bought the goods for you bought the goods from Bell. Okay, this one should be capital. Then for 700 on this date. So all these transactions are assumed to be on credit. Okay, all these transactions are assumed to be on credit. It will be mentioned in the question, but these are my examples, and that's why I haven't specified them very particularly. Okay, So if you buy the goods, you write the date, which is 13 January here, and then bell, and then 700 the amount. Okay, so if the invoice number is not given, just ignore it. And then if you buy the goods, if you bought the goods for resale, does not matter how much, again you are going to classify them like this. If it's on cash, it goes in cash book directly, no need to write it here. So what happens at the end of the day is, you are going to open the particular account. For example, ABC Limited, you are going to have an account for ABC, and you are going to have an account for Bell T account. Yeah, I'm talking about ledger T account now. And one account you are going to have for XYZ, let's say this one. So we are going to take the total over here, and we are going to post it into our T count of purchase. So we write here in the detail column purchase journal, and we write the total amount over here. Okay, and then the allocation of the total, which is this, right? I have just plus it. Okay, so this plus this plus this, so you should be getting this one. So the allocation of this one, this particular transaction, I'm going to record into separate accounts. So 700 belongs to Bell, 120 belongs to him, ABC Limited, and XYZ owe me, I owe XYZ 315. Okay, so the classification here is going to be purchase account. So if we total the credit side, it should be equal to debit side, correct? Again I repeat, if we total them up, so this one is credit, this one is credit, this one is credit, and this one is debit. So if we total the credit over here, it should be equal to the debit. Okay, because if you see logically, this one is adding up to this one, so of course if you add these three, it should be equal to this one. But I'm just saying a way to check, right? So as I've said earlier, this is the our format. We have journal first, then we post into ledger, trial balance, then income statement, and statement of financial position, which is balance sheet, right? So now from journal, this is journal. Okay, we take the journal, and then we take this amount and post it into ledger. Okay, so our we move from this point to this point. We have to take this figure and post it into T account. Okay, I hope that's clear. Yeah, so same thing happen in sales account also. So if you sell something, you will write the total like this. Okay, but the classification will be sales here, and then you will post it on the debit side, on the credit side, and the trade receivables are going to be on debit side. So the total in the sales account, you are going to have it on the credit side because it's an income. Okay, I can write here INC. This one is debit because it's an expense. And why this one is credit? Because it's a trade payable. Okay, so in the sales account, this one is going to be credit, and my trade receivable, if I were to have my trade receivable, it will be debit. Okay, because it's an asset. I have written trade receivable, you can write maybe asset in the bracket also for your understanding. Okay, but it's not necessary. So in detail columns, you can write sales account, or you can write purchase journal also. And then amount also is going to be the individual amount, okay, for each transaction. And then we have the concept of trade discount. So we have two types of discount: cash discount and trade discount. Cash discount is given on early payments. So for example, if you buy the goods from me and you ask me, can I pay later? And I will be like, okay. And let's say you are planning to pay me after 30 days, but then after 5 days I feel like I need the cash. Okay, after 5 days I feel like I need the cash, so I will ask you, can you pay me early, maybe like on by 10th from the date you have borrowed that thing, or the the date you have bought the thing from me. Okay, so I will ask you, can you give me the payment early and I will provide you the discount, or maybe I can have it as a term. Okay, if you make the payment by the 10th, I will give you the cash discount, maybe 10%. So you will intend to pay me early because you want that 10% discount. So it's just a way to collecting the trade receivable early. Okay, so if you pay me early, you are entitled to cash discount. But usually if there is cash discount, they will mention that if the customer make the payment before this date, then they are entitled to cash discount, let's say 5%. Okay, and then trade discount on the other hand is given on bulk. When you buy on bulk, like let's say you buy 1,000 chicken. Okay, so they will give you less price, maybe 5 ringgit per kg. Usually it's 9 ringgit, right? 7 or 9, I'm not sure, but they will give you some discount. So that is called trade discount. So now, for now, we are going to have a look at trade discount. Cash discount, we'll have a look at it when we reach in the cash book. Okay, so if you discount received, you just need to remember is from trade payable, and it's an income because you are receiving the discount, and the trade payable will give you the discount, the supplier. Okay, so he will say, if you pay me early, I will give you the discount. So for you, the discount he gave, let's say 5%, that 5% is income for you. And quite contrary, for the trade discount allowed, if you allow the discount to customer, if you allow the discount to customer, that will be an expense for you. So if you say to the customer, okay, you can pay me less 5%, so that 5% you are not going to get 5%. So that's an expense for you. So you can receive the discount, trade discount, or you can give the trade discount. Similarly with cash discount also, you can receive the cash discount or you can give the cash discount. So that's the concept. So if you bought the goods for 100 and you receive 10% trade discount, you just minus the 10% and you will get the balance. This is not the balance, you should be getting the 90 here. So the 10% of so I will take 100 times 10% and I will get the 10%, and then I will take this minus my this. So this is going to be the amount I am going to consider for my journal entry. Okay, so if you bought the goods for 90 and receive 5% cash discount, okay, this is not the main focus, but I'm just giving an example. Then I will include it into my T account. So this one is not included in my T account. Yeah, in my, this is included, 90 ringgit is included in my purchase journal. So let's say all these amounts I have here, right, these are after, these all are amounts should be after trade discount, after trade discount. Okay, so basically there is no entry for trade discount, which means there is no debit and credit for trade discount, but for cash discount there is. Okay, we will have a look at it later. So that's the main concept of this chapter. If you have any question, let me know. Try to do the revision questions. All the question will go through the questions as we go on. Okay, that's all for now.